Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.
Let's get into the topic for today, retirement annuities and annuities. So let's have a look at the difference first so that people understand exactly what is a retirement annuity and what is an annuity. So retirement annuity is a product that was created to help you save for your retirement. So that is the product in which you save your money. So the money goes in there, it builds up a capital asset. An annuity is a product that you invest the money that you've already saved in your retirement annuity into so that it can start giving you an income on a monthly basis. So the retirement annuity is the savings vehicle. The annuity is the income generation vehicle. So those are the main differences. So people get confused when they talk about annuities and retirement annuities. So the first part of the program today is I'm going to talk about retirement annuities, what they are, how they work, and the benefits, the detriments, the pros and the cons, and all of that. And the second part, we're going to talk a little bit about annuities, what your options are, how that works. So let's look at retirement annuities first. Now, if I still remember my dates correctly, the first retirement annuity was only launched in South Africa in 1957. I could be wrong. It could be 51. It could be 56. But if I remember correctly, it's 1957. I tried this morning to go and find the exact date, but I couldn't find the exact date. But it was in the 1950s. So we tend to think that these kind of savings vehicles and the way we prepare for retirement has been around for generations. And actually it hasn't. Actually, these retirement annuities, these products have only been around for about one generation. So if you are told that this is the solution for retirement, it's not because people have proven it over and over and over again. In actual fact, if you look at the proof, most of these products don't really solve the retirement crisis, or the retirement problem. But it was launched in 1957. The first company who launched a retirement annuity in South Africa was Liberty Life, and they then, all the other companies came on board, legislation was passed, etc., etc. So what a retirement annuity actually is, it's like a personal pension fund. So it works similar to a pension fund you would have at work. It's just you contribute towards it personally, and initially it was created and developed to add to pension funds that people have. Over time, group schemes, pension funds have become less predominant. In the past, most companies, especially big corporations, had their pension funds. Now more and more companies, especially small medium enterprises, don't give group schemes, which means the role of the retirement annuity has become more and more important in people's retirement planning in their lives. So what are the benefits of a retirement annuity? The first thing that everybody tells us about is that you get tax benefits from your retirement annuity. You can claim back your premiums that you pay from tax. But what does that actually mean? So the first thing you need to understand is that there's a limit to how much you can claim back from tax for your contributions to your retirement annuity, and for that matter on all your retirement savings. So that includes your pension fund at work as well as your retirement annuity. So in total, you cannot claim back more than 27.5% of your total gross taxable income. So taxable income. So your gross taxable income, 27.5% of that you can claim back from tax for retirement contributions. But that includes all retirement contributions. It includes your pension fund, and it also includes your retirement annuities. But there's also a maximum limit of 350,000 Rand per year. So if 27.5% of your taxable income is more than 350,000 Rand per year, then you can't claim more than 350,000 Rand per year. Now, let's quickly talk about how you actually claim it back, because people think that if I put R1,000 a month into my retirement annuity, that's 12,000 Rand per year. I'm going to get 12,000 Rand back at the end of the year from tax. That is not how it works. You don't claim your premiums back. What happens is any contribution you make towards your retirement annuity reduces your taxable income, and you will get the benefit of a lower tax that was necessary for you to pay. So I'm going to explain it and try and do it in simple terms, or as simple terms as possible. So let's say, for example, you earn 100,000 Rand and your tax on that 100,000 Rand is 20%. So 100,000 Rand for the year, 20%, that is 20,000 Rand tax for the year that you have to pay. But you go and you contribute 20,000 Rand for the year towards your retirement annuity. So that means your taxable income has now dropped from 100,000 Rand to 80,000 Rand. 20% of that 80,000 Rand is 16,000 Rand, which means you've paid 20,000, you only had to pay 16 because of the credit from your retirement annuity, which means you will get a refund of 4,000 Rand on your tax. Okay, so if you want to calculate, the easiest way is to take your contributions, calculate your average tax rate, and that's something we might want to discuss in a different topic. Exactly how much tax do you pay? Because people tend to think their tax is a much higher percentage than it actually is. But take your average tax rate and multiply your contributions by your average tax rate. So if you're contributing 20,000 Rand a year, your average tax rate is 20%, you will get back approximately 4,000 Rand from the 20,000 that you've contributed towards your retirement annuity. So you're not getting all the premiums back, you're getting a percentage back from your retirement annuity contributions. Now, what we always say is that what I suggest is that you take that amount that you get as a tax credit and you put it back into your retirement annuity, because that money you're getting back as a tax credit is actually free money. And the moment you put it back into a retirement annuity again, you're getting a tax credit on that tax credit again. So if you take that 4,000 Rand, you put it into your retirement annuity, you're getting 20% on that 4,000 again, which is another 800 Rand. If you put that back into your retirement annuity, you're getting another 20% on that 800, which is another 160 Rand, and so on and so forth. So you can continually put that money back into your retirement annuity so that you're getting free money going into your retirement annuity over time. Now, the reason you can do that is because on a retirement annuity, you can contribute towards it on a monthly basis, which most often is the case. People take out a retirement annuity for 1,000 Rand a month, 2,000 Rand a month, and every single month the money comes off your account. Or you can do it as ad hoc contributions as well. So you can say, listen, I want to add 10,000 Rand or 20,000 Rand or 50,000 Rand as a once-off contribution towards my retirement annuity. So when you get these tax credits or this tax refund, you can immediately take that tax refund and just contribute it towards your retirement annuity again, and it will count towards your tax benefits for the next tax year or the next financial year. Just a quick shout out, Frikkie and the new interns at our office all say hello. Hi Frikkie, hi new interns, great for you guys to listen to us. Welcome. For those of you who don't know, we run internship programs at iRetire and Retire Rich and Happy to teach some of the young people some experience in our industry, in running a business, in the different areas, so that they can get practically prepared for the future. So welcome, and we hope you are enjoying your time with us. Okay, so that's the tax benefits. Now, another tax benefit that people don't often explain with retirement annuities is that your retirement annuity is taxed at a lower rate internally than another type of investment. So for example, another investment is something like an endowment. So if you take 500 Rand a month and you put it into an endowment product, it's a savings plan, and you put 500 Rand into a retirement annuity, and both of these investments invest in exactly the same fund. So you don't have a different funds, you invested in the same fund. The retirement annuity will give you a higher return over time than the endowment, because inside of these products, tax are being calculated and paid over, and your retirement annuity is taxed at a much lower rate than your endowment. Your retirement annuity is also exempt from capital gains tax, where your endowment capital gains tax is paid inside the product every time trades happen in your underlying investment funds. So your retirement annuity will have a lower tax rate, which means it will have a higher return over time. Another benefit from your retirement annuity is that it is protected from creditors. So this is a big one. The money that you have invested in your retirement annuity as well as your pension fund at work, though that money is protected from creditors. So if worst case scenario happens and you have to be sequestrated, they can come and attach any of your assets in your personal name, but they cannot attach your retirement annuity and they cannot attach your pension fund money. So you can sit with 10 million Rand in a retirement annuity and nobody can touch it, not even you for that matter. You can also not put a retirement annuity on as security for a loan because it cannot be attached by creditors. So it is a protection. It's a worst case scenario protection for your retirement. So if everything else fails, you still have the money left in your retirement annuity, and that for me is a very big benefit, especially for people like self-employed individuals, because a lot of people that have their own businesses feel that, but why should I put money into a retirement annuity? I would rather invest it in other things. Well, there's still that benefit, because in business things can go wrong, and if something goes wrong, the money in your retirement annuity is still protected for your retirement. So let's quickly chat a little bit about the negatives on retirement annuities. So the first negative of a retirement annuity is that there's no access to funds. Once the fund in your retirement annuity reaches 11,000 Rand, so the maximum that's in that fund is 11,000, you can withdraw the money in your retirement annuity. But once it reaches 11,000 Rand, you cannot access the funds in that retirement annuity. It is fixed there until age 55. So a lot of people ask me, but if I've now contributed to my retirement annuity and I can no longer contribute, how much or do I lose the money that I put towards that? So the answer is no, you do not lose the money that you contribute towards that. What will happen is your funds will build up. Then if you cancel, it goes what we call paid up, that retirement annuity. So there will be penalties because the cost is calculated over the term of the investment. That penalties will be deducted from your fund value, and the rest of your money will stay in that retirement annuity until you are at least 55 years old. It will still be invested in the market, so you will still receive the returns on the investment that you have put into the market. And then when you get to age 55, you will be able to access those funds. And that is the second thing about the retirement annuity. The earliest you can access your funds in your retirement annuity is age 55, which is early retirement age. So then only can you access the funds in your retirement annuity. But what happens if you have a paid up retirement annuity? You have 200,000 Rand sitting in an RA and you are not contributing towards it anymore. And now you want to start a new retirement annuity with another company and you want to start contributing again. What are your options? So your first option is to just leave the money where it is, because it is invested in other funds than what you potentially would invest in the new fund, which means you've got some diversification in your portfolio. But you can also choose to move those funds from that old retirement annuity into the new retirement annuity. So instead of you starting at zero, you're now starting at 200,000 Rand to invest, and you then just contribute on top of that. That is what we call a Section 14 transfer, and it is a allowed transfer in the industry that you can move from one fund to another fund. Just keep in mind that it takes time for these Section 14 transfers. So your financial advisor, don't get upset with them if it takes 3 to 6 months for this money to be transferred. It is quite a timely process. And it's not the financial advisor, not the broker's fault. It is usually the industry or the companies that take a long time to do these transfers. Inside your retirement annuity, you are invested into different funds inside. So you could have 1,000 Rand a month going into your retirement annuity, but you might have 4 different funds inside. So it might be invested into an income fund, there might be some property investment, there might be some equity and some bonds, and maybe some gilt funds or something like that inside your retirement annuity. So, and your fund will grow by the combination of the growth on each of these different funds inside your retirement annuity. Now, you are allowed to shift between funds in the retirement annuity. So let's say, for example, your bond fund is not performing well and you feel that you want to move it. You can move the money out of that bond fund into another kind of fund or another fund in the same sector. So there is that flexibility. Just be very careful, guys, that most of the time these moves, you don't want to move your money and try and stock pick. You don't want to try and pick funds to go in trying to ride the waves. When you look at a retirement annuity, it is a long-term investment. You want to go into funds that you choose and stay in those funds for as long as possible so that you can get the compounding effect. Because every time you move funds, you get hit by the buy-sell spread in a double whammy. So let me quickly explain what the buy-sell spread is. Whenever you buy units in a unit trust, or you buy shares in a share, or you buy Forex, for example, the amount you pay to buy that unit and the amount it is valued at that moment to sell it is not the same amount. Your buying price will always be higher than your immediate selling price of that specific unit. It is like buying a car. If you walk into the dealership, you buy your car for 100,000 Rand. If you walk out and you try and sell it back to that same dealership immediately, they're not going to give you 100,000 again. They'll give you 90,000 Rand. That's what they call the buy-sell spread. So what happens is, let's say, for example, your difference between your buying price and your selling price is 5%, just for an example. So you move your money from one fund and you're going to move it into another fund. That buying price is 5% less than what you're selling. That selling price is 5% less. So you're losing out on that. Then you go and buy in the new fund, and that's 5% less again. So you're basically losing out on about 10% with that move from the one fund to the other fund. So be very careful when you're looking at moving your fund so that you don't get bitten by the buy-sell spread. But you can move the funds from one fund to another fund. Another thing that's important is, guys, be very careful when advisors, brokers come and tell you to cancel a retirement annuity to start a new retirement annuity. More often than not, I would say over 90% of the time, the only person that benefits from canceling one retirement annuity and moving it to another company is the advisor. It is not in your interest, it's in the advisor's interest, because he's getting to sell you another policy, which means he's getting commission on that policy. Be very, very careful of that, because what you cannot buy back is the time that you've invested in that product. So you lose that time that you've invested, and secondly, you're duplicating these initial costs of your investment, which negates a lot of the compounding interest effect that you might have received. So guys, if an advisor comes and sits with you, and all they want to do is try and move everything that you've got with one company, and we all know the D company that I'm talking about. So they all want to move everything into this one company, because if you have everything there, you'll get this bonus, and you connect this to that, and the knee bone gets connected to the thigh bone, and everything is all connected, and now it's in your benefit. Be very careful. It is most often than not, or more often than not, it is not in your best interest. It's in the financial advisor's and the company's best interest. So really, really do your research. Get second opinions. Make sure that what you are doing is right for you. And that is why it's so important to educate yourself. You cannot be successful at investing, at building assets, if you are a passive investor. You cannot be successful if you don't know what's going on with your own money. You need to educate yourself so that you can become an active investor. I'm not saying don't invest in retirement annuities. Don't invest in structured products. I'm saying teach yourself, get enough information so that you can do it on your terms and not the advisor or the company's terms. Okay, so that is the retirement annuity. So another thing is, on a retirement annuity, when you do retire from the fund, you have limited access to the funds. So you cannot just take your money and go and invest it and buy 3 properties. You can only access 1/3 of your money as a cash lump sum, and 2/3 of your money has to be invested into an annuity, which we will be talking about now. So you can't just do with your money whatever you please. At least 2/3 of that money has to be put into an annuity. The 1/3 will be taxed. There is a tax-free portion. The first 500,000 Rand is tax-free, and over and above that, you will be taxed on that. And the 2/3 that goes into the annuity will be taxed as an income in your hands, as you were receiving income at the moment. So the same tax laws that you are paying tax on your income at the moment will still work when you are retired and you're drawing income from an annuity. Another big thing with retirement annuities is that your retirement annuity always has to stay Regulation 28 compliant. So what does that mean? What that means is that you can't just put all your money into equities, for example. You are limited to how much money you can put into different funds or different sectors of the market. That limits your flexibility, which means you can lose out on great spikes in the market. So, for example, over the last year or so, after the COVID dip that we had, some of the equity funds have grown by 40-50% over the last 12 months. But through your retirement annuity, you cannot be 100% invested into equity. The maximum you can invest into equities are 75%. The maximum you can invest into property is 25%. The maximum combined between the two is 90%. So you can't have 75% in equities and a full 25% in property, because that will constitute 100%, which is not allowed. So you have to drop your equity if you want some property fund investment there as well. So there's all these regulations that limit you on the growth, and it's one of my pet hates is Regulation 28, but I don't have time to really go into why I feel Regulation 28 is a very negative thing for investors in retirement. Okay, so those are some of the negatives on your retirement annuity. Okay, so let's start talking about annuities. So you've now saved for 30 years, you've built up your little nest egg. In your retirement annuity, you are 65 and you are ready to retire. So what now? So like I said, the first thing you can do is you can take up to 1/3. Now, please be or understand this, it's up to 1/3. So you can take zero of your money in cash, or you can take up to 1/3, or anything in between. You don't have to take the whole 1/3. You actually don't have to take any of your capital out of your retirement annuity if you choose not to. But you can take up to 1/3. The other money has to be invested into an annuity. Just understand that once you have made that decision, if you decide, I don't want to take any of my capital, I'm going to move everything into an annuity, you can't 3 months later change your mind and then try and access that capital. Once that decision is made, it is made. The money is now in an annuity and you cannot access that money again. So that, just be very careful on that. So you now have to move that money into an annuity to generate an income. Now there's 3 basic types of annuities that you can choose to put money into. The first one is what we call a term certain annuity. Secondly is a life annuity, and thirdly is a living annuity. So I'm going to quickly touch on a term certain annuity, because when people retire, very seldom do you go into a term certain annuity, but there is like a hybrid where they do a little bit of a term certain plus then a life annuity. So let me just explain what a term certain annuity is. With a term certain annuity is you go to the insurance company and you say, listen, I have X amount of money, let's say 500,000 Rand. What is the maximum income you are willing to give me over a 10-year period? The insurance company will then calculate how much they are willing to pay, and they will say, listen, we are happy to pay you 5,000 Rand a month or 10,000 Rand a month for a period of 10 years. Once you are happy with that agreement, you sign the agreement, you pay the 500,000 Rand to them, and then that 500,000 Rand is not your money anymore. It is now the insurance company's money. They now have an agreement with you that they are going to pay you that income for 10 years. Doesn't matter what happens to the market, doesn't matter what happens to you. That income will be paid for 10 years. If 3 years down the line you had to pass away, that annuity will go to your beneficiaries, and they will receive the income from that annuity for the other 7 years. At the end of 10 years, that agreement ends, the capital is gone, and you have no more income. So that's why on retirement, it very seldom happens that people use a term certain annuity on their own. Okay, so that is a term certain annuity. Where we do see term certain annuities used is, let's say, for example, your father passes away before retirement, his pension fund money pays to you, you are the beneficiary, but you are in your 20s already, and it is pointless for you to have a life or a living annuity. So you want to get that money out as quickly as possible so that you can invest it. You would then put it into a 5-year annuity. It will pay you that income every month, and you can then invest that income, and after 5 years you take your investment and go and invest it for the rest of your life or retirement. Okay, so that's a term certain annuity. Now the second one is what we call a life annuity. So how does a life annuity work? So with a life annuity, you go to the insurance company. Again, you say, listen, I've got 500,000 Rand and I need an income for the rest of my life. So let's say, for example, you have R1 million available and you want to invest it for an income. The insurance company will then do the calculations. All the actuaries will look at it. They will look at your life expectancy, etc., and they will come back and say, listen, for your R1 million, we will pay you 5,000 Rand per month until the day you pass away. So they guarantee that income for the rest of your life. If you turn out to live to 120 years old, they will keep paying you that 5,000 Rand until the time that you get to 120 years old. If that means they are paying out much more than what you've paid them, they lose. And that is the risk that they take. But they very seldom lose because these guys calculate everything to the nth degree. Now, if you pass away 3 years down the line and they've only paid you, 120, 180,000 Rand over those 3 years, but you've given them R1 million, they win. Because the moment that transaction happens and you give them the million and they start giving you the 5,000 Rand, that R1 million is no longer your money. It is now the insurance company's money. You have bought a product from them for R1 million. You have bought yourself an income for the rest of your life. So if you pass away 3 years down the line, that is just toughies for you. You lose. So then you go, okay, but what if I pass away? Or what if I live for 10 years? I need this income to increase over time. I can't have 5,000 Rand a month every month for the next 20 years because in 20 years' time, that 5,000 Rand will be worth almost nothing when we take inflation to account. So then the insurance company will recalculate and say, okay, so we will give you 3,500 Rand per month. That income will increase with inflation for the rest of your life. And they'll usually put a limit on that inflation increase. So they'll say it will increase with inflation up to 10%. So if inflation goes over 10%, you will only get 10%. Okay, so if we get runaway inflation like what you got in Zimbabwe and some of our other neighboring countries, the insurance company doesn't take that risk. You take that risk. Again, same scenario. You say, listen, I'm happy with that. The moment that transaction happens, that money is no longer yours. They're now giving you 3,500 Rand, growing with inflation until you pass away. So if it's 3 years down the line, they've paid you 70, 110,000 Rand or 105,000 Rand and you pass away, that million is gone. It's not your money anymore. But then you say, but okay, I'm married. So if I pass away, my wife would still need the income. It can't just disappear when I pass away. They will then go back, calculate and say, okay, for a joint life annuity, so this now covers your wife as well, we will pay you 2,500 Rand a month, growing with inflation until the last person passes away, until you and your wife passes away. And the moment you do that transaction, the R1 million is gone. So if 3 years down the line, you and your wife passes away in a car accident, they've paid you something like 80,000 Rand, the R1 million is now theirs. That transaction happened. Okay, so that is the negative side of it. What is the positive side on a life annuity? Well, the positive side is if you had enough capital built up throughout your life that you can buy an income that is enough for you to survive on, you know you will never run out of money no matter how old you become. The reality of the situation, though, is that very, very, very seldom, probably like 1 or 2% of people will have enough capital saved up so that they can justify buying a life annuity so they have enough income to survive on. It happens very, very seldom. Another way that you can structure it is to do it through a hybrid structure where you add a term to this life annuity. So they would then say, listen, we will pay you this amount of money growing with inflation until you die. But if you die before 10 years, we will at least pay this money for 10 years. So worst case scenario, it will pay for 10 years. So they then link a term, but that again will decrease the income that they initially pay. So that could decrease the income to say 2,200 Rand a month instead of the 5,000 that you started off with. So each of these things have an effect on the amount of income that you will get. The income that you get from your annuity will be taxed at normal income tax rates. You will just qualify for better rates, and secondly, more rebates if you are over 65 years old. So that is a life annuity. The last option is, or the other option is to go into what we call a living annuity. So what is a living annuity? With a living annuity, the money stays yours, which means the risk stays with you. If you take too much of your money and you run out of capital, then that is your problem. It is not the insurance company's problem. In a life annuity, the insurance company takes the risk of you living too long. Here, you take the risk of living too long. So what happens, you invest your capital into the market, and that's also the risk you take. If you invest into high risk funds and the market takes a dip, your capital value depreciates, which means that you will then have less capital to generate income for you, and you will start running out of capital faster. So you invest your capital into the market, and you can withdraw a percentage of your capital every year as an income. Now that percentage is anything between 2.5%, so you have to withdraw at least 2.5%, but you have a maximum of 17.5%. That is what you can withdraw. You can withdraw that as either monthly, quarterly, or annually. So you can say, I want this income paid to me every month. You can say, I want it paid to me every quarter. Or you can say, listen, give me all my income for the year up front, and I'll get income again next year. I will manage it throughout the year. So that is up to you. Now, here's the risk. If you draw more income from your capital than what the capital grows by, your capital will reduce. So let's say, for example, you are drawing 12% income, but your capital only grows with 7%. That means your capital will reduce by 5%. So if you had R1 million in, your capital will reduce by 50,000 Rand for that year. And at the end of the year, you will only have 950,000 Rand left. And what then happens if you take more money than what the capital can generate, you start going into what I call the death spiral. So what happens is you take more income than what the capital can generate, which means your capital reduces. Next year with inflation, you need to take even more capital, but you have more income, but you have less capital to generate that income, which means you have to take a higher percentage of your capital, which means your capital reduces even more and faster. And then that keeps continuing, and you start getting into a death spiral where your capital becomes less and it has to generate more income. Less capital has to generate more income. The problem and the danger with the death spiral is that it happens so slowly initially that people don't realize that they are in the death spiral. And by the time they realize they are in the death spiral, it is too late. And then they cannot get out of the death spiral. And that is when people have to sell their houses, they have to downgrade their cars, they have to get a second or a part-time job to just start to generate some extra income because their retirement money is not enough anymore. Okay, so the income that you get from your annuity, again, is taxable according to normal tax rates. Another thing that needs to be understood is that the income is calculated at the beginning of the year. So let's say you have R1 million and you want to take 10%. That means you will have 100,000 Rand income that they will divide over 12 months. So that will give you a monthly amount, but that monthly amount will stay the same. Whether that fund goes up or down, your monthly amount is fixed for that year. So it can be that if you take 10% but the markets go down, that eventually your capital decreased by more than the 10% that you've taken in the beginning of the year. It might have decreased by 12% over the year. Once your capital in your annuity reduces to below 125,000, you can then withdraw the whole amount. So you can liquidate your annuity fund, take out the balance once it gets to under 125,000. There's no other time that you can access more than the 17.5% in your fund. Okay, you can move your capital from a living annuity into a life annuity. So you can decide at some point that, listen, I've now got 3 million left in my living annuity. I'd rather convert it into a life annuity because I have to guarantee my income for the rest of my life. You are allowed to do that, but you cannot move your income, your fund from a life annuity into a living annuity, because remember, once you have gone into that contract on the life annuity, you no longer have that capital. So there is no capital to move into a living annuity. It is gone. It is done. Okay, so what happens on the death of the annuitant? So you now on a living annuity, remember, on a life annuity, on the death of the annuitant, the money's gone. It's no longer there unless it was linked to a term. On the death of an annuitant in a living annuity, whatever's left in your capital will be paid into or over to your beneficiaries, whether that is your wife, whether that is your children, doesn't matter. It will go into towards your beneficiaries. They will have the option to take out a portion and reinvest the rest into a living annuity in their own name. They can take the whole amount and invest it into a living annuity in their own name, or they can withdraw the whole amount, and that amount will be taxed in your capacity. So it will be taxed in the capacity of the deceased, not in their hands. The good news, though, is that an annuity is exempt from estate duty. So any money that you have sitting in an annuity will not be part of your estate to calculate estate duty. So that money will go to your beneficiaries without being estate dutiable. So that saves a little bit of money there. Okay, guys, that in a nutshell is annuities and retirement annuities. Hey guys, Lourens here. Thanks for watching this video. I hope you found it informative and you got some benefit out of it. Please add in the comments any questions you might have or any other topics that you would like me to talk about. Please subscribe to our channel, hit the bell button so that you can get notified of any new videos that we post so you don't miss anything. Thanks guys. See you around.